Script for YouTube video, Wealthy Business. Breaking news. The Fed lowers interest rates again. On Wednesday, the Federal Reserve announced its third consecutive rate cut, reducing the benchmark interest rate to a range of 4.25% to 4.5%. Here's what it means and why it matters. Why the cut? Despite steady economic growth and inflation above target, the Fed is recalibrating its policy to prevent unnecessary economic slowdowns. Fed Chair Jerome Powell emphasized that current conditions no longer require restrictive rates. So what's next? The Fed's dot plot projections suggest only 2 more rate cuts in 2025, followed by gradual reductions into 2026 and 2027. This signals a cautious approach as the Fed aims for a neutral rate of 3% in the long term. Now let's dive into the economic projections. GDP growth has been upgraded to 2.5% for 2024, but is expected to slow to 1.8% in the coming years. Core inflation has been revised up to 2.8%, staying above the Fed's 2% goal. And unemployment is slightly lower at 4.2%, showing a resilient labor market. Interestingly, mortgage rates and Treasury yields have risen despite the Fed's cuts. This reflects skepticism in the markets about how much more the Fed can ease policy. So what does this mean for you? The Fed's rate cuts directly impact auto loans, credit cards, and mortgages, potentially lowering borrowing costs. However, rising market rates could offset these benefits, especially for home buyers. The takeaway here is that the Fed is walking a fine line between supporting the economy and managing inflation. How this plays out will affect not just Wall Street, but your personal finances as well. Stay informed with Wealthy Business for the latest on how these decisions impact the economy, your investments, and your financial growth.